Please welcome the panel on the evolving landscape of asset-based finance and securities products, moderated by founder and host of Capital Allocators, Ted Seides.
Well, thanks. We're going to dive right in, and I want to go, we'll go down the line the other way. Start with Edwin. Name, quick round. Name, organization size, and your hobby that's most unlike your day job.
Great. Good afternoon, everyone, or good morning. Edwin Wilches, I co-head Securitized products at PGIM. PGIM manages about $1.4 trillion of assets within securitized products. We manage about a little bit over 140 billion. Something unlike my day job, I love music. I used to DJ quite a bit, and I try to pass that on to my kids at this point in my life.
Thanks. I'm Jason Steiner. I'm a portfolio manager at PIMCO. I've been at the firm about 17 years. PIMCO is about a $2 trillion asset manager. Our securitized product business is about $250 billion. Hobby, I guess, I like to have a competitive New York Times crossword puzzles contest, speed runs with my wife.
Great. Madelaine O'Connell. I am at HPS. The size of our firm is about 160 billion of AUM. On the high grade side, that's about 15 billion. On the ABF side, much broader than that. We can go into the details. My fun fact or side hustle is I am a fitness instructor on the side, so get paid to work out. I teach Pilates and sculpt and have been doing that for years at 6 a.m. Does not interfere with the day job, I promise.
Jack Neumark. I'm at Fortress Investment Group. We have about $50 billion in assets under management. And I guess my interesting hobby is I go to dance competitions with my 9-year-old daughter more weekends than I'd like to.
Matt Miller. I'm with Bayview Asset Management. We're a $20 billion asset manager. We've just celebrated our 32nd year. We've been in asset-based finance across mortgages, both residential and commercial, and all verticals within consumer. I also enjoy DJing, crossword puzzles, fitness, not so much dance competitions. When I was younger, I used to do improv comedy, and now I write essays about what I'm going to eat for lunch.
Okay. So I think it's probably been a while since we would have had this many people in a room talking about asset-based finance, or maybe it used to be called ABF, or whatever the acronym was at the time. I'd love to kick this off with a description of, as you're talking to investors, what encompasses your definition of today's market of asset-based finance?
Sure. So I think asset-based finance is really looking at any kind of assets that produce income or cash flow and finding ways to invest in those. And these assets have existed, obviously, for a very long time. We've had a long mortgage market, a lot of consumer debt forever. I think the acronym ABF, becoming popular these days, is really sort of the structured products equivalent of private credit to the corporate market.
Yeah, I think he hit most of it. Generally, when we think about asset-based credit, we're thinking about the private side of the ABS market. So we're thinking about all those products out there that are securitizable, whether it's consumer flows or resi flows, and thinking about those in the context of the private credit alternative. I think we also think about asset-backed credit in terms of more idiosyncratic asset classes, whether it's patents or litigation assets or music royalties or things of that sort. So we try to use a broad view, and what we ultimately talk about with investors is somewhat dependent on the product and the return and what people are focused on from an asset perspective.
And now you're going to have to start to try to be additive.
I think the whole panel. So yeah, for us, the way we describe asset-based finance, and I totally agree with you, there's so many definitions out there and there's so many ways to attack the space, but it really depends to what you just said around what is your cost of capital, if it's investment grade or is it non-investment grade, is it private credit 1.0, are you moving into ABF, or is it really private credit 2.0 in our minds, which is investment grade. And so we think about it as kind of structured corporate deals, which I think we'll get into, which is obviously topic du jour, $5 to $25 billion off-balance sheet financings for some of the largest global public IG companies. And then obviously all of the other asset class, anything that could be securitized in the real economy. The way we break it down is GPLP solutions, fund finance, a huge growing vertical in this space, consumer, commercial, aviation, transport, esoteric. And again, you're going to have investment grade in those deals. You're going to have non-investment grade. You're going to have residual equity. And how can you attack all parts of the capital structure as a firm is where ABF is headed.
I think maybe I could add one more wrinkle. Maybe is again I think ABF as a term has kind of come around because when we talk to our clients, they're looking for diversification within a private credit allocation that's been largely focused towards direct lending or of course real estate debt. So it can be a bit of a catch-all definition, but it really covers, from the client's perspective, a portfolio completion tool away from assets that have had already a lot of capital allocated to them. And then you could break it down into kind of a consumer angle and a non-consumer angle, as Jack mentioned as well, kind of esoteric, idiosyncratic risk that's uncorrelated to broader financial market conditions.
Edwin, in the envious position of being the fifth person to ask the exact same generic question.
Yeah, maybe I'll add, ABF is not really a new product. It's been around for decades. This is financing that's already been occurring in the economy. The difference is now, two things are happening. You're having this convergence of public and private. So as Matt said, to some degree, a lot of the assets that we're financing in ABF are assets that we may have already been financing in the public securitized space, except now there's more opportunities to get closer to the origination. For us, one thing that is clear though is when we speak to clients, what ABF is not is idiosyncratic risk, right? So I think a lot of the merits as to why we're talking to clients about ABF is you're diversifying away from corporate credit risk within fixed income. So the contractual cash flow nature, the hard asset nature, the secured nature gets you away from even with something like tariffs. You didn't have any ABF sector that was particularly, you have this issue because they are importing or anything like that. So I think of it more as it's non-corporate is kind of step one, and then it's everything else that finances the real economy.
Does anyone else want to take the other side of ABF as not idiosyncratic risk?
I think it depends on what you're putting in the ABF at the end of the day. So I think there are certain parts of ABF that's out there that is more idiosyncratic. It starts to get more specialized, smaller markets, less scalable. So it's not going to drive a lot of the opportunities that most of us are focused on. It's certainly not going to drive the investment grade opportunity. But I think there are things you can structure that are cash flows that are not correlated to the markets and that are outside of the consumer resi aircraft traditional ABS.
Yeah. I want to dive in on certain aspects of this. Madelaine, you mentioned 2.0 investment grade. If I were skeptical, I would say, well, you just sold to a very large asset manager, so no wonder you have to find a bigger pocket of opportunity. Where have you decided are sort of the best risk rewards in the space?
Yeah, I think as you think about, there's 5 of us on stage, there's probably 90 of us running around pitching ABF, and everyone has a different angle of how they're approaching it. They might own a small platform and they're selling that cash flow stream or hard assets, or they may be kind of providing everything. So I think for us, especially as you mentioned with our new branding with BlackRock or combination, I think we're really trying to cover everything. So the way we think about the space is being able to attack everything, having the institutional horsepower and integrating into what already exists in private credit 1.0 from a skill set, information gathering, where we've participated. Where we're probably not as active, and others on the panel can talk, is consumer. That for private credit 1.0 just hasn't been an area that we've dug deep and gone deep in. I think everything else from commercial, aviation, we own platforms, we have different arrangements across many of the asset classes. I think in the investment grade space at the moment, the best risk-adjusted return is really within GP/LP solutions as we define it. So fund financing to either the GP level, the LP level, whether that's a GP unsecured deal or NAV facility, a CFO, a rated feeder. And because we have cost of capital from AA all the way down to preferred equity, we are just going to clients and providing them with a solution and figuring out what is the best risk-adjusted return, what is the best structure, and we're agnostic to where that goes from a investment-grade capital versus non-investment grade capital. But I would say for investment grade, it's really within that GP/LP solution space.
How do you think about the varying levels of risk and return and where you can play? If you're covering everything, there's two ways of thinking about that, right? One is you're trying to find the right solution for the right client, and the other is you've decided, hey, it's an opportunistic fund. This is the area that you like best.
Yeah, I think it depends, on the fund. It depends on the client's needs. It depends on the issuer's needs. And so we just want to go to them and be able to provide a solution. And so having that broad spectrum of capital base is important. But I think it's very specific, especially if you think about the investment grade side of things and the insurance companies being the main clientele there. They all want customization. And then you're competing against, do you have a life insurance mandate? Do you have an annuity mandate? Do you have a P&C mandate? And where can you play? And being able to toggle across all of the asset classes, we can really just move with the market and put our clients into best risk-adjusted returns. And having the institutional knowledge on the non-investment grade side and the investment grade, we know where relative value is, we know where structures should be, and that's pretty compelling to our clients.
Other thoughts on risk reward? Yeah.
Yeah, I was going to say, I think there's a couple things also. It's important to our clients that they are making investments in private credit where you're giving up liquidity, you're basically ceding some of that ability to transact in the markets, that you're being paid for it, right? And so a lot of what we're talking about when we're investing in ABL is looking for, risk-adjusted returns, as Madelaine said, but also we're generally looking for investing in asset classes where the compensation that you're receiving from a spread perspective largely is going to comprise of the illiquidity premium that you can capture, as well as some complexity premium, as opposed to taking kind of directional credit risk. And I think that's one of the big misconceptions, and it's why you'll hear a lot thematically over and over again about how IG credit, IG private credit is very important, because this is not always the case where it's always going to be very credit risky instruments. In some cases, in the case of a lot of the consumer-related assets, in the case of mortgage-backed securities, for example, or mortgage loans. Right, these are very well-protected assets that will perform well in a wide range of economic scenarios, and so you want to make sure that you're structuring investments, that you're allocating to asset classes that are going to pay you for the risk that you're actually taking and not for the credit risk.
Yeah, I definitely agree. Particularly when you're talking about risk-adjusted return, the first part of that is kind of adjusting for the risk. So we spend a lot of time thinking about how resilient is the investment that we're going to make across economic scenarios, which, as Edwin pointed out, in a lot of the space you can find investments that are not as sensitive to some of the tariff noise that's occurring right now. So within Bayview, over the cycles, where we're investing kind of changes as that equation changes. And sitting here today, probably our biggest core conviction in terms of risk-adjusted return is really anything having to do with the homeowner. So it can be mortgages specific, it can be other consumer assets, to homeowners, and within homeowners, specifically people that have owned their home or took out a mortgage during the COVID years when rates were close to zero, right? So since that time, rates have gone up. These borrowers, if you think about it, bought their house and had factored in a certain shelter cost. Because of their ability to refinance, they've brought their shelter costs down, probably lower than they ever expected it to be, right? And luckily in America, it's almost a birthright of Americans to be able to take out a 30-year fixed-rate mortgage that's freely prepayable. So now as inflation has gone up, assuming they've had some wage inflation, hopefully they're actually net winners during that wage inflation. And you can see it not just in mortgages, but also other asset classes lending to those consumers. And that's not to say like all mortgages are risk-free, particularly people that are just buying a house today and stretching. We are seeing stretch borrowers. We are seeing kind of reburbs of COVID in terms of just the average FICO in America being higher than it was historically, but not necessarily performing to those higher levels, really performing more in line with what their previous FICO would have represented.
Yeah, I'd say, we're seeing the same thing, and I think thematically, the homeowner is definitely in a better place. The Federal Reserve Board had a stat a few weeks ago, the average net worth of a homeowner, median, excuse me, in the U.S. is about $400,000. The median net worth of a renter, the 40 million plus, is $10,600. Right, that wealth gap is pretty stark. But when you're looking at the consumer space, right, it's an $18 trillion consumer balance sheet. In ABF in particular, and as you're partnering with different originators, you can start to define the pools of capital that you want to lend against, and whether that's obviously direct mortgages is one way to do it, but then there's also home improvement, there's things like solar, and there's even unsecured loans or semi-secured loans where we see historically where you see folks, as Matt was saying, especially around any mortgage done before 21, the performance of these loans is much more robust than the average loan, and FICO is a metric, but it's not, definitely not, I'd say, a leading indicator. So I definitely underscore that. And I think for us, we like to have a wide field of vision. Our, focus has not been to own the origination, right? We kind of like to say, we can still make some eggs without owning the chickens. And, if you have issues there, we can move between different spaces. Consumers definitely one. I think fund finance is one. What we see is as markets start to get hot, and I think, SRT was a good example of that, when there was a lot of capital getting raised, the opportunity set starts to move around quite a bit, quite quickly. And it is nice to be able to kind of look across all these different sectors. It's $40 trillion. There's probably easily close to 100 subsectors that you could look at. You need big teams, you need a lot of technology, you need a lot of depth. But if you're able to prosecute all that, there's a lot of interesting opportunities. But homeowner is definitely one that I think thematically across all our businesses we're definitely seeing as a strong indicator of performance.
Jay?
Yeah, I think we're probably a little bit unique, at least on the panel up here, because we are so heavily weighted towards opportunistic on the asset-backed side. So I think all these dynamics in the market are right for us as spreads have tightened and the space has become a little bit more efficient on the securitization side over the last 12 months. We've had to be more creative in terms of how we get our exposures. So I think we find more illiquid opportunities that typically require a little bit more value add, whether it's teaming up with a joint venture counterparty to try to create a build to rent opportunity and taking risk on land and development, building turn down programs with counterparties from scratch where they previously haven't had turn down programs in place, lending against settlement receivables from litigation where we can get a massive spread to the risk premium of the underlying defendant that's paying the settlement. For us, as these markets fluctuate, and we can lean into the lower risk upmarket stuff, we'll do that. But then as markets tighten and we get priced out, we tend to get really illiquid and add complexity to get the returns.
How do you think about pricing the trade-off of that additional illiquidity in what's generally thought of as a less liquid area?
Yeah, I mean it's an absolute and a relative return analysis. I think we look at what returns we're getting on these assets, how deep our attachment points are, and what overall return we can get for taking that incremental risk. But we're constantly watching the opportunities in the ABS market. We're watching the opportunities in the more upmarket transactions, and if we think we can participate in those markets, we're more inclined to pivot into those markets. They're more liquid. They're probably easier to scale. And so we sort of just have to watch what the opportunity set is and move in and out based on what's available.
So with Jack teeing off, like maybe the on-the-run ABF isn't as attractive as it had been, would love to hear what are some of the areas that you see more risk and on the margin you're avoiding?
Yeah, I think there's obviously as Edwin kind of highlighted, there's an outlook or expectation of a little bit of a kind of two-speed economy for the consumer, right? And so when you look at consumers that are backed by or consumers that are homeowners, there's a lot of resiliency expected to continue there. Edwin highlighted the kind of the net worth gap. I think another thing that's really important to think about is just the amount of home equity that's available in this country, really since COVID. The mortgage market today is about a $13 trillion asset class. The aggregate value of all homes in this country is about $40 to $45 trillion. So there's a tremendous amount of home equity, and that provides you with a lot of security. But that also leaves you with kind of like everyone else. And Edwin, I highlighted the $10,000 kind of like net worth number, which is pretty shocking. I think as a bifurcation. And so where should you look, or where should you avoid? I think you should look at some risks down in credit in consumer as being places that you should be cautious on. It has to be priced appropriately, of course. But there's two main dynamics to think about. One is we've come out of an environment where post-COVID, even low credit or weaker credit borrowers were given a lot of stimulus that has provided them with the ability to continue to pay debt that otherwise they would not be able to continue to support. That pulled down delinquency rates in things like subprime auto and other sectors to levels that are very low. And so if you look at those levels rising, they're probably rising at or through kind of the pre-COVID levels today, but it doesn't mean that's where they're gonna rest. They can continue to go higher. The other thing that I think's somewhat interesting as an implication for things you should be careful about in the markets, I think Matt alluded to as well as FICO scores. The kind of long-term impact of COVID era policies is that FICO scores have been effectively inflated. Right? If you were a 620 FICO score borrower, pre-COVID, all your debt was either paid for by the government or was, postponed and kind of deferred. There was even policies that were implemented during COVID that didn't allow servicers of consumer debt to report delinquencies to the credit rating agencies. Right? That's kind of moved or kind of created kind of a right shift in the aggregate FICO of the aggregate consumer. It used to be the case that credit scores in this country were kind of normally distributed around a kind of 680 FICO. Today it's probably closer to 720 or 730. When we look at investing in mortgages, for example, right? We look at like the non-qualified mortgage market. When we were buying loans at PIMCO, 10 years ago, we were lending to borrowers with a 680 FICO score. Today it's probably more like a 735 FICO score. I don't think the borrowers have gotten that much better. Right, the same borrowers, so everyone's kind of moved up in credit because the economy's been so robust for a long period of time, and anyone that did go delinquent, you kind of didn't really know about it. So again, it kind of all goes into like the depth of analysis that you need to do to really kind of weed through a tremendous amount of data that makes up these markets. And the good thing about it is that the data comes at you very quickly. Right, it's not high frequency data; it's kind of low frequency, high volume data. Right, mortgage servicing data comes at you every month. You can get a really good real-time kind of like update as to how the consumer in aggregate is performing, and then you can slice and dice that data however you want.
Yeah, I think some of the risks. Look, I kind of think of it's interesting in terms of like folks always ask us like relative value, and I kind of decompartmentalize it in a few different ways. Right, like there is just absolute spreads coming in, but I think that's a bit of a false signal in terms of where relative value really is, and kind of similar to the FICO score point. For us, it's like, okay, so if I'm getting X spread, but I'm lending against worse collateral, that's riskier. And I think we're definitely starting to see some folks open up the credit box more and more and more to achieve a certain level of return that we think, maybe this is not the best time, given kind of the tales of all the unknowns of what's going on in policy. The other piece is, the covenant protection. One of the features of private markets, in particular private ABF, is you have the ability to negotiate or ability to incorporate risk mitigation. If things don't go as well as you thought, there's ways for you to, either take servicing fees or other, things for you to protect your investment, protect your downside. So we see some of that start to get diminished. And last but not least, when you do these financings, there's also embedded options sometimes, especially in fund finance, right? So I think for us, it's like you look at these three, and then maybe there's more, but in my mind, those are the three that I'm constantly thinking about. How am I pricing? These are all little options that I'm pricing. Like the spread is only spread, and then obviously, how you achieve it matters a lot. I think the other piece, that we're definitely seeing is, folks are, probably paying a little less attention to documents, which again, I think as a structured credit investor, it's something that lives, within us, so to speak. I think in other markets, particularly corporate markets, you've definitely seen the degradation of documents, and you start, hearing about new acronyms, LMTs and LMEs, liability management exercises, as a consequence of that. In securitized products, I think the GFC taught you had to know your docs. But I think we're starting to see financings today where there's certain features that you expect to be in the docs that aren't there, right? So we do a lot of bilateral. What's that?
An example of something you passed on.
I mean, we're passing on a lot of different things around just like the ability to relever assets, like a lot in mortgage, right? To the points earlier, right? Like you have home price appreciation, the mortgage actually de-risks. There's a lot of these structures now, and data centers is a good example of the ability of the operator to add more leverage as the valuation goes up. Historically, as an investor against that hard asset, you benefit from the appreciation of the asset. Here, you're not seeing that. So there's a whole host of things that, there's like kind of the first principles investing, like, what's your asset, what's your downside protection, what are the covenants you do, how does the document or the structure protect you? When you start seeing all these things get diminished, I think that's where you start seeing the risk. And you see that, and again, I'd say it's a hot market, but it's 40 trillion or 20 trillion or 10 trillion, whatever the size is. It's existing loans, right? So it's not like we're coming in with 40 trillion of capital or 20 trillion, but you are definitely seeing more folks coming in, and that's where I think, from our perspective, having a wide field of vision is really important, because you start seeing certain segments get really hot because there's some fundraising that's happening, and that's usually where you start to see kind of a little bit of sloppiness. Outcomes don't necessarily, are not good indicators of like the risk decision that you made. So sometimes these things prolong for a long time, kind of silliness. But we're starting to see some of that on the margins, again, across all these different kind of risk factors, if you will.
Maybe I'll just add one thing. If you think about the investment grade space, which is a big component of ABF, I think sometimes you can synthetically create investment grade risk. And so I think, they've alluded to a lot of the points, but you really have to have the underlying credit view, do your fundamental credit underwrite, then you get to the assets, you start to understand, analyze, get the data, make sure it's the right assets, can you service said assets if something happens, and then you get to kind of the investment grade rating and structure to get there. And I think some participants are maybe going the opposite way. And I think that will be interesting just to watch, especially on the investment grade side. None of us, there's ratings for a reason, there's risk-based capital regimes, it works for different things. Ultimately, we come up with our own ratings assessment, but it is just something to watch in the market.
Madelaine, is there an asset underneath that you think could become the subprime mortgage of the next cycle if we do head into a recession?
I'm definitely not going to opine on what asset class. No, I mean, I think, I don't know that there's a particular asset class that this is happening. I think just as more capital is coming into the space, it requires more assets. And especially as you think about insurance as the first buyer based on investment grade, now you think about pensions coming into this, now you think about retail coming into this, you have to create a lot of product to feed those mouths. And so I think it's just more across the board. You just have to make sure as the investor that you understand the risks you're taking. And if it's investment grade, great, but do we just believe the risk and are we getting the right return for said investment grade or investment grade piece of paper?
Yeah.
So I think it spans across all the asset classes, and it's really about structure.
Jack, is there a mistake that other stupid people are making in the market today?
No, I mean, I think what we're watching right now is just the increase in prices that people are willing to pay originators for flow, and the uncoupling of the alignment that I think was becoming very popular in the market over the last 18 months by having the originators willing to defer their servicing fees or give you some sort of yield maintenance if your loss assumptions didn't play out as the management case said they would. And so you're sort of going back to the regime that was a little bit more popular pre-22 when there was a hiccup in the market as everything's becoming a little bit more efficient. So we're watching it. We tend to shy away when people start paying up for these loans. And I'm sure, as Madelaine said, there's a lot of insurance capital chasing these opportunities. I think the insurance space is sort of doubled in private ABF over the last 4 years or so, and people are looking for ways to deploy capital into asset-backed, and so there's going to be people that potentially are willing to pay too much, and then the other issue is are the people widening the credit box to create that incremental flow, and it's that combination that becomes more dangerous, where people are trying to create flow to fill funds or fill balance sheets that are looking for this, and they can generate that by paying more and widening the credit box, and then you have an asset or a portfolio of assets you paid too much for, you don't have enough cushion on your downside, and you actually have a higher default rate and higher loss rate than another type of portfolio.
Yeah, so I've got a lot I kind of want to respond along that way, but Just starting with, I think, probably the biggest risk, and Jack touched upon it, is like when you're selling liquidity risk and you're taking liquidity risk, the way that can come back and really burn you is if you're providing too much liquidity to your investors or to your lenders, right? So like I don't know if anybody's really doing that, but that's probably the biggest risk that one needs to stay away from. Within the kind of the specific asset classes, Jason and I kind of agree that with the FICO drift, that's been driving a lot of the subprime auto delinquencies up recently, right? So if you just look back, the people that didn't realize that was happening, because from their point of view, you do have to understand underwriting guidelines, but that did not look like underwriting guidelines were widening. That looked like underwriting guidelines were staying the same, and then lo and behold, particularly if you did it in an illiquid fashion, now you're kind of stuck with this investment. So, it's really important to understand not just the underwriting guidelines today, not only understand how the recent performance performed, but also what's happening in macro that may make your investment looking forward perform differently than simply, investing using the rear view mirror, right? So, just like the FICO drift helped a lot of people, all the stimulus helped a lot of lower FICO outperform. For those originators that were simply using AI and thought they had figured out how to be smarter than banks or traditional underwriters, suddenly came to the brilliant conclusion that their machine was smarter than FICO, until suddenly FICO mattered again, right? And another thing that's been happening is not just the stimulus checks and the FICO drift, but surprising to a lot of home price predictors, when rates went up, so did home prices, right? So even though I'm very, very bullish on the homeowner, I'm definitively not bullish on home prices. I think home prices are arguably as rich from a price to income standpoint as they were in 2006. I don't think housing is going to collapse the way it did, because the average LTV today is so low that housing can come down without triggering any strategic defaulters, or if the economy turns, causing people who lose their job to have no other options other than defaulting. So I still think the homeowner is very resilient. As I said, it was my highest conviction idea to begin with. But I also think, looking back, people may be surprised how much home prices going up might have bailed out some of the more levered or riskier underwriting guidelines.
Jack, I want to jump into sourcing opportunities. And maybe across the panel, try to get to the pluses and minuses of origination or sole sourcing. You mentioned a potential risk of the originator's behavior needing to source that with all this capital coming in. How do you think about why you don't have your own origination platform?
So we do have a portfolio company that does originate secured and unsecured consumer credit, and so we buy some of that flow, and obviously that's a nice partner to have, because we're able to set the credit box. We know exactly sort of what their approach is to originating credit. I think for most people on this panel, it's not as efficient as a financing source to go out and build an origination platform. I think on the consumer side, in particular, on the resi side, it's easier to let people specialize in that, be capital light, build their platform, and then find partners that you can buy that flow from that you see eye to eye with from an underwriting perspective. But I think from our perspective, how we source traditionally, or how we built a lot of our relationships, is by doing rediscount lines or lender finance to earlier stage fintech companies that are just building their businesses. We provide them 85, 90% advance rate loans against their portfolios. We get to know those organizations as they grow and develop. We then get to work with them or find ways to work with them in the future. So it sort of becomes a way to build a sourcing channel over a long period of time. But at the end of the day, your relationships are going to fluctuate. People are going to find different sources of capital. They're going to find capital that's more efficient, and you just have to stay in front of those markets and be willing to, hold the line on what you'll accept from a credit box perspective and from an underwriting criteria perspective. And sometimes you'll find ways to work with them, and sometimes you'll have to move on. As you've looked at probably a growing universe of these fintechs as they come up, what's your diligence process like to figure out which ones you want to align with? I mean, ultimately, they usually have to have some amount of equity and some amount of origination that's already started, so we can see, what their performance is. But I think where we're willing to take risk is on a smaller set of data if we know what that asset class is and we understand those underwriting criteria. So if we have a certain view on unsecured consumer lending in certain markets, we can take a limited subset of data with that earlier stage fintech business and sort of extrapolate what we think they're ultimately able to do. We require haircut capital. We require them to be capitalized and have a minimum net worth, so we know that they have real skin in the game. And then you just have tighter covenants and an ability to watch their performance, so you can cut your tails quickly. But the haircut capital and the cushion you have, gives you the ability to take some of that risk without potentially having your capital impaired.
Madelaine, how have you thought about sourcing across increasing types of assets and then scale as you've grown?
Yeah, I mean, it gets to the question you just asked Jack around, do you own or rent, right? I mean, at the end of the day, this is all about origination and sourcing and getting close to the assets. And so you can do that in a number of different ways. At HPS personally, we own a couple of platforms, those that we just believe in the platform. We've had conviction in the platform. It's less about creating the IG risk or otherwise. And I think we'll probably strategically over time add more platforms. But if you can rent and utilize other people's resources and knowledge of those asset classes, we think that's another compelling way to originate and source. I think the third leg is really about partnerships, whether that's with the banks, with your clients, being the incumbent lender for us on the non-investment grade side. As some of those deals get taken out in ABF fashion, you're seeing that more and more frequently, and having the institutional knowledge over 5 years as they were a below investment grade issuer, and now you can do the ABF takeout. That's another source of origination. And then as you think about, as I mentioned earlier, sort of the structured corporate deals where these global, IG companies are looking for off-balance sheet, either ABF deals or structured corporate deals that many are putting within this ABF bucket. That's really, do you have that call into that CFO and treasurer, not just the capital markets person? And we think we have that from an origination sourcing perspective for these large, $5 to $25 billion types of transactions that you're going to see more and more. So I think it's a combination of renting, owning, bank, advisor, sponsor relationships, and then corporate relationships.
What are some of the subtleties of understanding how you align incentives with either the ones you're renting or owning that you might not know if you're not in the market?
Around, well, I guess if we own the platform, obviously you have the incentive alignment. Yeah. I think if you're renting, you're really looking at a pool of assets that you're getting from them. So in a forward flow arrangement or something of that nature. And so what you really want to focus on there is the servicing capabilities of said issuer or said borrower. And I think on the corporate side, obviously there's, that's more of a one-off kind of nuanced situation. So a little less focused on that.
Yeah. Edwin?
Yeah, I mean, I think the question for us is always, what are clients kind of looking for? What are we trying to deliver? And we're consuming some of these ABF assets for our own balance sheet, for some strategic partner balance sheets, and then obviously clients. I think today we don't own any originators, and maybe that changes at one point in time. I do think there is this inherent conflict. There's a bunch of conflicts that come up when you own the origination, right? One is the valuation of that equity that you own in that platform ultimately is going to be driven by the amount that you originate. And if you're originating and then you're technically selling these loans off to yourself and others via alignment, that it could cause you at points in time to originate for the sake of originating because you're getting this gain on sale and the servicing strip, right? So that's how the equity gets valued. So there's an inherent conflict that just, in one side, you just want to originate a lot and take as much fees. On the other side, you're hoping you get paid back, right? So I think that's one point. The other point is, how do you price that risk appropriately, right? When you're lending to your portfolio company. Now, if the LPs or the investors, the SMAs own the portfolio company as well, that's one thing, but I think it's still quite challenging to do that. For us, I mentioned a few times this kind of field of vision concept. The other piece, I think when you have the origination, and that's really what the strategy is, perhaps home ownership today is our best idea, and I agree, but it may not be 5 years from now. And I think being tied to that origination means that you have to support that asset and that origination kickoff when it makes sense and when it doesn't make sense. So I think, again, I think there's a lot of nuances there. But, look, I think earlier, I think Jack mentioned it, right? Skin in the game is a really big one. How do you kind of balance that out? I mean, we have partnerships. We're not looking to disintermediate the banks. We think there's a ton of space. Again, right, you go back to it's a multi-trillion-dollar market. There's not, like, you need to almost take a step back and say, all right, how do you prosecute this the best way? Like, how do you find the best assets? Sometimes it's, you know, working with bank partners. Sometimes it's working with originators directly. In some cases, it's working with, you know, some of the equity folks. But ultimately, I think, you know, having kind of this broad view is really, really important. And again, the rent to own, there'll be maybe a point in time where there's a very unique asset where, you know, it's really hard to come by otherwise. But generally, we're pretty cautious on that.
Yeah, I've got a couple thoughts on that because I do agree with the incentive angle. Particularly what we've seen is a number of originators held in certain funds and the credit going to other funds, right? And then as a GP, are you trying to maximize the equity return for Fund A, or are you trying to maximize, you know, kind of the credit ABF returns for Fund B? You know, at Bayview, we've been an originator for most of our existence, both in resi and commercial. Our origination platforms are held by the GP and run effectively at break even. So the main objective of both our originators as well as our servicers, and why we have over 2,000 people, is to maximize the returns for effectively our ABF funds and ABF investors. And if you just kind of think about the ecosystem, you know, when a portfolio of loans of pretty much any asset class comes out to trade, the larger the opportunity, you know, kind of size opens eyes, and it will trade at a richer level than where the loan level would, which makes sense because at different parts of the kind of chain of aggregation, if you will, there's a profit that needs to get that needs to be collected. So a mortgage originator that's trying to stay in business is making loans and then selling those loans for as much as possible and collecting several points in value if they can, particularly when volumes are high. But in a perfectly vertically integrated kind of chain without that kind of middleman and without the conflict of interest between two funds, really, you know, the way that we've set it up, our credit funds are able to kind of access the credit really deeper down in the value chain.
Jason?
There's a couple things I want to hit on. A lot of what we're talking about with the sourcing, a lot of it comes down to, you know, portfolio construction as well, right? So when you think about, you know, building out an ABF portfolio, right, you want to deploy your client's capital, right, safely and soundly, but also relatively quickly, right? And so, you know, going and at a PIMCO, we've made a lot of headway, you know, starting from the financial crisis in buying bank portfolios. In 2008, 2009, I was buying, you know, non-performing loans from banks that needed to, you know, fix their balance sheet and reduce their NPL ratios. Today, it's not necessarily an issue of NPL ratios, at least not in the U.S., but banks still need to sell assets because of, you know, asset liability mismatches, because they originate a lot of mortgages at very low rates, and their deposits were not as sticky as maybe they thought. But you know, when you buy a portfolio, you know, a $5 or $10 billion or $20 billion portfolio from the banks, you know, as we frequently do, one of the challenges with investing in this space is that, you know, next month those borrowers are going to pay you back some principal along with interest, and so it's a feature of the asset class, very dissimilar to, you know, traditional private corporate credit, where, you know, you lend money on day one and you get your money back 7 years later if everything goes well. In these asset classes, every month the borrowers are paying you back principal and interest, and it's a natural de-risking. But as a portfolio manager, it also leaves you with the question of how are you going to deploy that marginal dollars that come back into your strategy, right? And so you have to be able to source both big and small to be effective in this asset class. And so you need, you know, these big relationships, because again, that might be an opportunity to differentiate yourself and source a lot of assets very quickly. But you also need some of these small relationships with these origination companies. The conflicts there, I think I agree with all the points made on the panel so far. One other thing I think it's really interesting to think about when you think about a partnership with a small, lightly capitalized origination company, is how do you align interests when you are effectively their balance sheet, right? You are the one that's providing them their balance sheet. So there's definitely, you know, an argument to be made that, you know, the separation of church and state should be maintained, and that you don't need to, or you don't want to own those originators. And you could definitely run your business very effectively, you know, for a very long period of time, as long as if that's the model you want to stick with. We've also found opportunities at PIMCO to be, you know, to not be, you know, sole owners of a business, where a risk might be that you know, as a captive owner of a lightly balance sheet company, you are the balance sheet, and if relative value changes, right, you still have to keep using your balance sheet to originate those loans, or you got to shut down the company, and that's not always that easy to do. It's certainly not as easy as people would think. And so there's a middle ground, and the middle ground might be making a minority investment in a platform, making a warrant investment as opposed to direct equity, where over time, if that company grows, if the balance sheet that you're providing them, is a productive relationship, and the company goes from originating, $500 million a year to $5 billion a year, you could still participate in the equity valuation, multiple growth and equity expansion that company will have without being completely tied to its future. One of the common sayings in the space is like, do you own the originator, or does the originator own you, right? And that's a really interesting dynamic to think about when you're investing in this area. The last point I wanted to make is, when you think about the diversity of asset classes that you can invest in, the origination obviously matters as well. Some of the asset classes that we're talking about have very wide lanes, right? You can invest in things like mortgages or consumer credit, the $10-20 trillion market, right? Yes, there's opportunities owning originators in those spaces, but there's a lot you can do without owning an originator. Some of the more narrowly focused or kind of more niche sectors within the asset-based lending or asset-based finance, right? There might be actual value in owning those platforms because of the scarcity of the asset makes it really difficult. When we think about, again, going back to a portfolio construction, what's important is ultimately the sizing of those asset classes, right? So at PIMCO, we try and offer, our clients, diverse, we want to manage money with as broad of a range of investable asset classes as we possibly can, because we think that'll lead to the best risk-adjusted returns over a long period of time as relative value changes within those subsets. There was a time period, in 2020 and 2021 where we observed a lot of clients going very narrowly into, more niche sectors of the asset-based lending markets, because global bond yields were basically, 80 basis points for the 10-year, and you could pick up, 10 to 12% returns investing in, more esoteric asset classes within the ABS space. Those opportunities might still be fine, but they should represent a smaller portion of the overall capital that you allocate to your fund or your strategy.
So a lot of the question of portfolio construction seems like it's getting driven by one thing we haven't talked about yet, which is cost of capital. It just changed so much with insurance coming in. Edwin, why don't you kick that off? And how do you think about your relative position to others as it relates to the cost of capital you're trying to achieve when you're putting portfolios together?
Yeah, look, we have a broad array of clients, and I think the beauty of securitized products forever really is it affords you the ability to kind of pick and choose where you can satisfy your investment grade clients, and you could also satisfy your non-investment grade clients with buying similar assets. And what I mean by that is, and I'll just stick to consumer because it's much easier. We can buy what we deem is a cheap pool of loans. And given the underwrite, we think that's an investment grade rating. We also do our own internal ratings. Given the dynamics today of kind of the arc of where regulation's going around banks, banks have been much more. They don't want to make the outright loan, but they want to give you loans on loans, if you will, in terms of like they want to lend you capital. They want to be senior. So we're seeing the financing of some of these assets also be pretty attractive, right? So for one account, we might say, okay, for the investment grade strategy, we're going to buy the whole loan because we think it's cheap and it offers good relative value. For the more non-investment grade or the higher yielding account, we could buy the same pool of loans, but we could work with a bank or we could securitize it and sell a senior, right? So there's just ultimately it's again like it's the asset. We're originating cash flows. And this is true, I think, across public and private, candidly. It's not that different, especially in securitized. How you originate them is a little different. But ultimately, being able to partner with, if you're talking about from the originator's perspective, being able to bring different sources of capital, whether, even to Jason's point, I think was excellent, and I think Matt was making it as well. You want to make sure that, if there's a way for you to get some upside in the growth of that business, you get it. But, that does require different pockets, right? Not every IG pocket's going to be able to do an equity warrant. So I think, look, generally, we're a really large business. We have a lot of different pools of capital. I think even within the insurance company, there's definitely appetite, to the extent that there's a growth opportunity for us to consider it there. So I'd say it's really, pretty powerful. I think this is where scale really matters in ABF. I truly believe that, because I think, you not only can drive the financing, but you also, everybody's money's green. It's how can you align yourself as a strategic partner in different facets of the business over time. So it really, I think, whether it's IG or non-IG, I think, there's a lot of white space here.
Jack, Matt, I want to ask you, as very, very large minnows compared to the other people on the panel, how do you think about competing in a space when some of your competitors have such a wide range of sort of different cost of capital across their client bases that ultimately you're looking presumably for something a little bit juicier than maybe what their most conservative clients may look for?
Yeah, I was sort of referencing this earlier, but I think this is when we need to be more creative. Ultimately, that's going to allow us to create a product that maybe is differentiated from what our competitors can offer us that have more scale. So, whether it's going to somebody we have a long-standing relationship with and trying to create a turndown program, second or third or fourth turndown program where they haven't been historically doing that, and we can monetize origination that they hadn't previously been able to monetize. That can be one way to differentiate an opportunity and get something that's almost on an exclusive basis. We can go to somebody that has a capability to originate and suggest a new product that we have experience in working with other originators on, and try to educate them and put some elbow grease into it, and ultimately get exposure that way. So obviously, if we can find stuff that's regular way flows, over the last couple of years, there were more opportunities to buy at 96, 97, 98 and get really good alignment and yield maintenance. As those sort of become more difficult, as spreads tighten, we have to do what I think we've sort of historically done at Fortress, which is probably take more risk, but also go more liquid and more complex, and try to use that to create opportunity.
Mm-hmm.
Yeah, so we've been obviously, and I don't want to use the word competing because I like everybody on the stage, but looking for investments, I guess next to whales when we're a minnow. And I think the way that we've approached it is we really focus, because Bayview is such a large operator, we really focus on investing opportunities where we can kind of create a moat. So while in terms of like assets under management, we may look kind of small relative to some of the others on the panel, we're literally the largest owner of mortgage servicing rights in this country. We're one of the largest mortgage originators. We're a large commercial mortgage originator. We have operating platforms across our businesses, which really helps us create moats that no matter how many assets under management another firm may have, they just simply can't compete.
Most of the questions that have come in are a little spicy and are all kind of tied to some version of concern about risk. So I'm just going to, we have a few minutes and we can try to cover some of these in a pseudo lightning round. So the first is, how are you positioning your portfolio for the coming default spikes during a known stagflationary economy? I threw in a couple words there. Anyone want to jump in there?
I'll jump in. I think a lot of the principles that we highlighted, or that I highlighted earlier, I think are relevant here. One is if you're going into weaker economic environments, you generally want to go up in credit, not down in credit. That's going to lead to IG credit being more in favor. Again, you want to make sure you're being paid for complexity, and you're being paid for liquidity, as opposed to being paid for that kind of directional credit risk, or really making investments in investments where if you're wrong about the scenario that you're underwriting to, the return that you're going to get, it could be vastly different. So investing in things like structural mezz, I'm surprised that that we haven't spent a second yet talking about SRT at all. But those types of investments where you're ceding control of the servicing or asset management of the asset class, but you're also structurally mezz, right? That's potentially a dangerous place to be if the economy is weakening. So prefer to go up in credit, prefer to try to get paid for the liquidity and the balance sheet that you're providing, and avoid levered or kind of binary type risk profiles.
How much flexibility do you have to pivot the portfolio?
Well, again, we talked about it earlier. One of the nice features of this asset class is that you get back principal every month, right? So if you have an asset class where, if you have a portfolio where a lot of your assets are invested in these amortizing, self-liquidating assets, right? It's not going to happen overnight, right? But you can certainly imagine scenarios where you can reposition your portfolio over the period of 6 to 12 months, and that might be enough to protect you against downturns, right? I think that's the market has shown us in 2022, it's shown us in 2020, kind of what turned out to be somewhat head fakes against a real weakening of credit. And this time, might be another head fake. It might be real, but hopefully people have learned the lessons of putting portfolios together that will be resilient when the economy changes very quickly.
Yeah, and I think on the higher quality investment grade side of things, if you look at liquidity during these times in the private side, it's actually been more liquid in certain times than the public investment grade market. So one could argue, as there is volatility, you're actually better positioned to change the portfolio or move in and out of asset classes if you're on the private side. And as more capital comes into this space, many have said it, you're going to start to see, especially within ABF, is there really a difference between this private public, whether that's from a structural perspective, a spread perspective, what are we creating here? That's a bigger question that I think we'll all answer over the next couple of years, but I actually think there's more liquidity sometimes in periods of volatility on the private side.
You want to dive just quickly into what you think that matters? Sorry, what that means?
I think it means spread compression to a certain extent, more and more capital, at least on the investment grade side, coming in, chasing these assets, needing to deploy capital, needing to compete on the annuity side, willing to go either down in quality, down in structure, down in spread. And so I think it's being very vigilant around, are you chasing the assets or are you really trying to properly deploy capital and properly position a portfolio? And again, as you think about, private credit 2.0, insurance, now you think about pension, there's just so much capital that's going to flow in. And yes, it's a $40 trillion plus market, but can we create the right risk to, feed the appetite of many institutional, and we haven't even talked about retail coming in. And so, are you still going to be talking about that 150, 250, 300 basis points of excess spread to come into ABF and private markets? That probably compresses over time.
Yeah, and I think, some of this stuff is it's like modeled returns, right? Especially when you're looking at some of these consumer assets. I think people forget, you focus sometimes on just delinquencies, but the prepays can kill you. I mean, Jack was saying, people are paying higher prices. I think the sensitivity, how do you protect yourself? How do you kind of risk manage this stuff? One, you got to be super disciplined, right? I think all these things we talked about earlier, you also have to do some scenario analysis, understand, all right, how bad can it get? How much variance, how sensitive is my return on not just delinquencies, but even prepays, because we have seen this dichotomy of the consumer, and what we've actually seen is really high prepays of the really good credits and really quick defaults and delinquencies of the poor credits, which in a pool is the double whammy you don't want. Because the good credits, you want them to pay you as long as they can, because they're going to pay you back anyway. And the weak ones, if they're going to default, you kind of hope they give you a couple more coupons along the way. So I think, it's remaining extraordinarily disciplined and coming back to, how do you structure this stuff? But I agree. I mean, portfolio positioning, I think it has to be dynamic. You have to be thinking about your cash flow. How do you reinvest? And I'd say, look, I think credit, we constantly remind ourselves, right? Despite credit curves feeling quite linear, especially in securitized products, where the rating category, you just add 100 and you kind of know where it is, risk is exponential, and it goes really fast. So given how flat all these credit curves are, and I think we're all kind of saying similar things, just stay up in credit. The beauty of this environment is the yields in fixed income are quite high, and the ability for clients to get 6-7% in IG is quite unique. You don't have to go, kind of into the riskiest part of the credit spectrum in a tough time. Sorry.
The only thing I would say is, it depends on what you're getting paid. So you can go up market and think you're taking less risk, but if spreads have compressed on the higher grade consumer credit, and sometimes you might be better off owning subprime if you have 99% APRs and you can really compensate yourself for 40% losses. Subprime can only get so bad, whereas near prime, can obviously get a lot worse because you're almost pricing it like prime, but you're potentially taking subprime risk in a downturn in the economy. So I do think it matters what you're getting paid. The other thing I just say, I really agree with discipline. I think all of us up here are shops that are very focused on disciplined underwriting, control, and structure. The terms of your leverage are really important too in times like this. You need to make sure you're not going to get caught in an environment where you have margin calls or you have mark-to-market issues. If you've underwritten your book and you think it's going to make its way through the storm of whatever's happening, the last thing you want is to be wrong on your leverage, but right on the asset. And so making sure you have that structure in place is really important.
Matt, final word?
Sure. Let me be the blue cheese to that spicy question. First is, if you're thinking now, oh my God, we're about to have stagflation and defaults, how do I reposition my portfolio? I would argue you haven't been doing risk-adjusted returns to begin with. Yeah. So if you've been assuming the credit's going to stay as good as it is, and there's no probability in terms of your cone of probabilities that defaults are going to get worse, I feel like you haven't been disciplined, and I think we would all kind of agree with that. But the other thing I would say, more specific here, is picture yourself 5 years forward and looking back. What asset class do you think is going to be the most resilient if we do have a stagflationary downturn economy? And just again, given the starting point of the average mortgage homeowner in America right now, I would argue that that is still the most resilient scenario, asset class you can be in, even if that is the path that the economy takes.
Great. Perfect timing. Thank you all so much.
Thanks.
Thank you.